Fun fact, between 2001 and 2020, income from real estate globally amounted to more than the income generated from stock markets, which not only shows you the potential for capital gains, but is a great example of diversification and risk reduction in action. There are two main ways to access the real estate markets, and not just through the front door either. Let's find out in this episode of How to Invest by Julius Baer. In basic terms, investing in real estate can be split into two main categories: direct and indirect. As the name suggests, direct investing means you directly purchase real estate, and it can be anything from your next home to office buildings, logistics centres, or hotels. You may want to live in the house yourself, construct new properties, or overhaul existing ones for sale or lease. In direct real estate investing, you hope to generate incomes through rental payments and the appreciation of the value of the property and/or land, leading to capital appreciation too. Looking at the first 2 decades of the 2000s on a total return basis for global property investments, you could earn a decent total return of 7% per year on average. Of that 7%, 5% would have come from the income return and the other 2% from capital growth. That's real concrete returns, pun intended. The indirect approach, on the other hand, involves investing in real estate through things like real estate investment trusts, REITs, or exchange-traded funds, ETFs. So rather than owning the bricks and mortar itself and having to buy, manage, and finance that property, you own shares in a real estate portfolio. And on top of owning a share of physical real estate, you can also access infrastructure investments, so things like cabling, energy lines, or mobile phone towers. Indirect approaches can be especially attractive, considering that office buildings in the best locations can cost 9-figure sums, making them very unrealistic for most people. Owning a share makes it not only much more accessible, it's easier to exit this kind of investment too, as you continue to grow and diversify your portfolio. Now, as direct and indirect investing both offer advantages, how do you choose which way to go? Well, that choice will depend on factors such as individual preference, available capital, risk tolerance, and how hands-on you as an investor wish to be. For example, indirect investments offer greater diversification potential. Investors need less capital to buy their share into the investment and can therefore afford to spread their capital out across different real estate sectors. Meanwhile, direct investments offer scope for higher returns, both through rental income and capital appreciation, but typically require more active involvement and a sound understanding of the market. And this is crucial. Real estate is basically a local asset class driven by local demographics and economic trends. And because of this, it can often be more effective from a performance perspective to invest in your local market or be guided by specialists in particular countries than to blindly invest in a global fund covering many different markets. Of course, that option is still out there and has enticed many investors to build up an international portfolio. Large institutional investors and sovereign wealth funds have helped to propel this shift, attracted by the generally stable income, the scope for diversification, and the varying possibilities to reduce risks and enhance returns. What is clear with all these options, your risk appetite will be the very foundation of any decision regarding a real estate investment. And especially with the changing interest rate environment, it's all the more important to select the right instruments and strategies. Don't miss an episode of How to Invest by liking and subscribing to the Julius Baer YouTube channel. And if you have investing questions you'd like us to answer, just comment below. And we'll see you next time.